Aretec's message is that obviously things are more volatile out there. There's no question about that. But we are sticking with our process. We're not just watching and observing what's happening. We're actually doing something about it. We're actively managing your portfolio. As I mentioned, we were making trades earlier this week. We made trades earlier this year. We were making trades late last year. We are responding and adapting to what's going on out there.
This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth.
All right. Hello and welcome to the Realize Your Wealth podcast. Hope everyone's doing well. Will has been away from the office, but he's been working closely with us. There's been a lot going on. We've made some moves this week, so we've been in close contact with Will, but we have Roman here in his place. So Roman, welcome back. You're starting to become a little bit of a regular. How are you feeling?
I feel great. Happy to be here again. It's been a couple times in the past few weeks that I've been on the podcast, but I think the first time ever that I've been on the Realize Your Wealth podcast with you, Greg. So lots going on out there in the world and markets, lots to talk about, and look forward to diving into it with you here.
Yeah, it's timely that you're on because we've joked at different times that you're kind of our geopolitical correspondent. You seem to know what's going on around the world. There's lots of stuff going on around the world, but no, we're excited to have you on here, Roman.
Awesome. No, looking forward to it. And just to dive into things, and I think, a great way to start would just be, because so much is happening out there, what have we seen in markets this week, just overall?
Yeah, it's a good question. And just to kind of start and set the stage, like markets have had a very different kind of start to the week as it is to an end of the week. I should mention we're recording this on kind of like Thursday night. So just as the markets are closing on Thursday, so a lot can still happen on Friday. But to give it, from a high level perspective, Monday, Tuesday were actually pretty decent days in the market overall. We saw a good sized rally on Monday that continued a little bit into Tuesday, which was good to see. And I think a lot of that was just the last couple of weeks. There's just been a lot of selling pressure going on with everything, particularly going on in the Middle East. But then Monday, Tuesday, we saw a nice kind of rally, and we actually took advantage of that, which we'll kind of go into a little bit. On Wednesday and Thursday, like the volatility has definitely picked up. U.S. markets, as of now, are kind of finishing on the lows for the year. The TSX was reversed sharply. It was leading the markets. It was one of the strongest indices. It's kind of pulled back. Obviously, Friday remains to be unseen. What I think kind of happened on Wednesday is that there was a lot going on Wednesday. You had the U.S. Fed and the Bank of Canada both come out. They both held interest rates, and they both more or less signaled that it's just going to be a wait and see, and that there might only be one rate cut or potentially no rate cuts, which the markets didn't particularly like. And then also you had the U.S. inflation number come out, which came in a little bit hotter than anticipated. So point is, there's a lot going on. And then obviously the undercurrent to all that is everything going on in the Middle East with oil prices staying elevated. And really what you're seeing is that oil prices are kind of inversely related to the stock market at this point. So energy prices go up, markets seem to kind of pull back. Whenever we get good news on energy prices that they're coming down, the markets tend to do well. So point is, there's a lot going on. There's a lot to unpack. So it's been a pretty busy week here overall.
For sure. A lot of different factors driving market volatility and uncertainty being very heightened that we're seeing right now. So as it relates to the overall exposure to markets, different asset classes for our clients, what moves have we made this year and what are we looking to do moving forward?
Yeah, so it's a good question. So I think we talked about this on the podcast last week or so. So in our tactical wealth portfolio, TWP, we've really more or less been taking profits and locking in gains going back to the end of last year. So it was back in November of 2025 where we actually sold, a decent sized position in technology, XLK, which is, a spider technology ETF that owns a lot of, NVIDIA, Apple, Microsoft, Broadcom. So we started to take some profits then. And then really since that point, we've really just kind of been underweight equities. So, for growth investors where maybe we're kind of at, our neutral positioning is 80% equity, 20% out of the market. For balanced clients, our neutral position is more like 60% equity, kind of 40% out of the market. We've really kind of just been underweight equities all year. And then what we actually did, which we'll dive into more on the podcast here, is we used the rally earlier this week, so on Monday and Tuesday, to actually get more defensive in the portfolio. So we sold some names, we sold some equities to just kind of reduce our exposure even further, which has given us a little bit more cash to help us navigate some of this volatility, but also to allow us to be opportunistic, if and when that time comes. So, clients, investors right now, they're probably closer to maybe, 15 to 20% kind of underweight their neutral equity target asset allocation right now. So all that to say is that, our positioning right now, it's more conservative, it's more defensive. We've used some of these rallies to lighten up our exposure and just have more cash overall.
Makes sense. With the tactical wealth portfolio, we're tactical as it relates to the asset allocation, making these shifts and changes for clients, but we still do have that equity piece in the portfolio. So, as it relates to the equities themselves, how are we making, sector shifts, or really where are we allocated, and how are the equities allocated for clients?
Just to almost take a step back. So as I mentioned, like we were raising, we were getting more defensive this week for all intents and purposes. So what we were doing, and a little bit from our playbook, is that we were selling some equities, we were selling some stocks that had just more or less started to break down a little bit technically, that weren't looking that good when we kind of look at it from the medium to long term. That being said, some of these names were showing a little bit of a short-term bounce. So we were using that short-term bounce and kind of taking some profits. And then the names and equities that we have kept are the areas of the market that are actually working and showing, what we call relative strength right now. So couple examples right now. Industrials has continued to do really well. So we've owned industrials for a long time, like aerospace and defense, global defense, obviously not for the most friendly reasons, but given everything going on, it's showing leadership and relative strength. We've also kept, a little bit of international exposure, which has done well. And then, of course, which we'll talk about more, but gold and materials, although we are seeing a little bit of a pullback, has continued to show kind of that long-term leadership. All that to say, right now in the portfolio, we're definitely more in a defensive postures. Our indicators are telling us to be conservative and defensive, which is exactly what we're doing when we look at both of the overall asset allocation, but also our equity exposure.
Yeah, and I think you touch on a big piece of the conversation that we're having today, and a big piece of client portfolios being gold itself. It's had a fantastic run. We've held it for clients for many months now, but we are seeing some more volatility recently. So I guess just high level, what's your thinking right now with gold, especially with the increased volatility over the past weeks and from what we're seeing today?
Yeah, it's a good question. So, the thing, I guess, just to set the stage to remember with gold is that, yes, it has defensive characteristics and properties, and it tends to do well in uncertain times, and investors will kind of flock to gold when there's heightened risk, heightened uncertainty, everything that we're basically seeing right now. But the thing to remember is that it's not immune from volatility. So, we really started to enter a position in gold. It was really back in November 2024, with right after the U.S. election. It pulled back. We saw a pretty good buying opportunity, and really since then, gold has just gone on a, some would say a parabolic run, right? So when you look at, kind of the miners, just physical gold overall, some individual positions, are up 70, 80, 90, 100+%. We've owned Agnico Eagle mines for a long time. It's been a long-term hold for us. That's up well into the triple digits. So getting a pullback here, it's not uncommon and it's not unexpected given all that. And like the one thing I would say, and I think we talked about this as well, is with some of this volatility that we're seeing in the markets, traders are coming in and they're selling the stuff that has worked and that has done really, really well. So, for us at this point, that doesn't mean the trend has changed. It just means we're seeing some short-term pressure from the areas of the market that have done really, really well. So that's kind of what we're seeing with gold from a high level. And then, you know, in addition to that, I think there's a couple other reasons on why we're seeing some shorter term pressure. One is that we are starting to see a strengthening US dollar. Basically, since 2024, the US dollar has more or less been weaker overall, and gold tends to act inversely to the US dollar. So US dollar goes up, more or less gold tends to go down, and kind of vice versa. So there's been a strengthening US dollar, and a lot of that also has to do with there's a lot of talk right now about rates being higher for longer. So potentially not as many interest rate cuts from the Fed, or potentially even none at this point. And like most assets, gold tends to do really, really well when rates are going down. If rates are not going down or they're staying higher for longer, that's just going to bring some shorter term pressure on it. So all that to say, right now, as it stands now, the trend is still in favor of gold and gold equities. It's still at the top, or at the very near top of our charts in terms of relative strength against its peers. We've seen this before a lot in 2025, where you'd see gold pull back, 5, 10, 15 plus percent, but it's still held its, medium to longer term relative strength. And through that time, we've continued to see it go higher. So right now, gold is still the leader. I can't predict that it will stay that way forever. Our process is going to change, but right now it's still holding on to its longer term strength. And if and when that does ever change with our process, we're going to follow the trends and we're going to listen to the heartbeat of the market. But what you're seeing right now in kind of gold, I think it's just a shorter term correction in a longer term kind of still upward trajectory and an upward trend.
Awesome. I think that's a great analysis. And we've talked about some of the different asset allocation shifts, some of the different sector shifts, and we've talked about gold being a big piece of this. Just going back to my role here as the geopolitics and global conflict question master, and with the war going on in the Middle East, and also I guess with the Fed meeting having taken place, lots of talk out there about inflation. How should investors feel or think about inflation moving forward?
Yeah, so inflation is kind of coming back into the fold. Not really actual inflation, just kind of the discussion around inflation is coming back into the fold, kind of given everything going on in the Middle East, more specifically with higher energy prices. So, I mean, we've all seen that, prices at the pump have gone up, and obviously that's a little bit of a concern. But what I would say is, if this is kind of more a short-term blip where we see higher energy prices, even though energy prices have gone up, 30, 40% in a relative short amount of time, if this is relatively short-lived, the impact on longer term inflation is likely to be, more minimal. That being said, if we see this, go on for, months and months and months, and we see energy prices, stay elevated, then I think we could, look at maybe some of the longer term implications that these higher energy prices are having on inflation. The one thing I would say to just give some perspective, so we all remember 2022, and we had everything going on with inflation. You had the markets on the whole for that year not be particularly great. But the one thing I more want to kind of mention and emphasize is that inflation story in 2022 had a lot, or had basically everything to do with what happened 2 years earlier in 2020 with the pandemic, with COVID, right? In 2022, we did see higher energy prices for a relatively short amount of time when we had the Russia-Ukraine conflict start, and we saw elevated energy prices, albeit for a relatively short amount of time. That in and of itself did not really impact inflation long term. It more had to do with what was going on a couple of years before with the pandemic. So we've talked about this a lot on the podcast, how a lot of these economic factors, they take, months and months and months and, possibly even years for them to kind of work their way through the economy. So yes, it's not good that we're seeing, short-term higher energy prices. Is that going to have a long-term effect on inflation? Hard to tell at this point.
Makes sense. And now, we've touched on the portfolio, some of the different pieces, taking a deeper dive there, a little bit on the geopolitics side of things. Just to summarize things overall for clients, because obviously there is a lot going on out there. What would be your message to investors and clients if you had to summarize it?
Yeah. So my message, Aretec's message is that, obviously things are more volatile out there. There's no question about that. But we are sticking with our process. We're not just watching and observing what's happening. We're actually doing something about it. We're actively managing your portfolio. As I mentioned, we were making trades earlier this week. We made trades earlier this year. We were making trades late last year. We are responding and adapting to what's going on out there. So right now, our portfolio, we're in a much more conservative positioning, a much more defensive posture. And the one thing that I would mention as well is investors are going in, they're looking at their portfolio, they're seeing, accounts are down or accounts are off the highs. But when you kind of look at the benchmarks, the indices, our portfolio, we're actually in a really, really good spot overall relative to everything that's going on. And the one thing that I would say, probably maybe even more important than that, is that the portfolio itself is very defensive. We have a lot of cash. We have a lot of conservative pieces. So we're doing our best to kind of manage through this volatility. And as we've said on the podcast countless times, and when we think back to more volatile periods in the market, so last year with the tariffs, even in 2024 around the election, 2022 obviously with the inflation story, 2020 with COVID. I mean, name your time. These moments of volatility, do present the best, buying opportunities. And I'm not saying we're there yet by any means, but we're doing everything we can to manage during this more volatile period. And when that time comes, because we know that time will come, we are ready to respond and adapt. Overall, like just for some perspective, we can't control what's going on out there with wars or inflation or anything that Trump is doing or saying. But I just want investors to know, to be assured, we're managing the portfolio, we're governing it accordingly, we're sticking with our process. And at the end of the day, we're going to come out on top and on the right side of all this. So all that to say, lots going on out there, but we're sticking with our process. We're governing and managing the portfolio accordingly. So all that to say, we want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. That's what Aretec Wealth is all about. Will is going to be back. He's been working all week, but he's going to be back in the office next week. So we might do another video kind of early in the week, maybe kind of on a Monday, Tuesday, Wednesday, kind of a midweek video, similar to what we've done a couple weeks ago. But if you have any questions, we're here, we're working, let us know. And other than that, enjoy your weekend, and we'll talk to everyone soon.